great pleasure to have Thomas Peltonen, Deputy Head of the European Systemic Risk Board, Christopher Koch, Deputy Head of the Division Financial Stability at the European Central Bank, and also Joe Stiglitz, Columbia University, who will add some comments on the presentations. So could you please make sure everybody gets in? We will finish at, we need to finish by 3:15, because Joe has an important appointment outside with the, his office. And then we will have, so we have actually moved the coffee break in that break, right? So we'll have the coffee break between 3:15 and 3:30, and then we'll have the last practitioner sessions between 3:30 and 4:30. Don't miss it. We'll have Alternative Banker Schweiz and other, and Julius Baer present in the session. And then we'll have a short wrap-up together with Marc Chenet, Director of Department of Banking and Finance. So let me join the panel. I'd like to say just a few words. So I want to reconnect this session to the session that we've been seeing this morning. So we started with a session focusing on the relation between interconnectedness and systemic risk, and analyzing what are the drivers of systemic risk in addition to interconnectedness. And we saw that leverage is an important dimension, and somehow mispricing is also another important dimension that is also connected with bankruptcy costs and recovery rates, which essentially determines whether the system is conservative or not, as Joe was mentioning in one of his comments. Then we moved up in terms of complexity, and we looked at a network of financial derivative contracts. And there we discovered that properties that at least those, at least we believed that we had understood something in the network of normal contracts, and then when we moved to derivative, we discovered that there are properties that don't hold anymore, and things are actually qualitatively different. Then we had another session that was examining the question of what do you do when you don't have full information, and how you can use, and even when you have full information about the network structure, what can you do in order to essentially not just say how much the financial system is stable or not in that very moment, but attach a sort of interval of confidence, if you want, or a narrow bar on the estimation. And how you do that? Well, you build large sets, ensembles in the technical term, of feasible and viable financial networks. And that allows you to have an idea of where the system could go. Now, we're now moving to the fourth session, and we will learn how these network models and network data are used for both financial stability policies and macroprudential regulation. The difference between the two is that, well, my colleagues, they will say more precisely, but financial stability is more about looking at how shocks get either absorbed or amplified within a system in a rather more static setting, while macroprudential is more looking in a forward-looking way at anticipating also the behavior of the strategic behavior of the actors. And that's where I want to make a little comment. Together with Joe, we are currently working on an extension of the previous work on the price of complexity in financial networks, and we are trying to examine the question of what happens when you endogenize the systemic risk in the following sense. I want to point out to the fact that interconnectedness and systemic risk can also be the sort of the equilibrium of a process, because once in the beginning interconnectedness is perceived as a good policy because it's essentially helping actors to absorb shocks, And many policies are actually encouraging to do so, like the policy that recommends to have the single largest exposure limited. You limit your single largest exposure, but then in so doing, you are getting connected to more and more financial institutions. That is good, but only under the condition in which you are in a conservative system. So shocks, when they get spread around, but they get diluted, they don't get amplified. But once you get into a system that is more interconnected, necessarily the financial system will realize that it is in a position to take more risk than it would otherwise. So there's a form of moral hazard, and that leads to excessive risk-taking. And excessive risk-taking materializes typically in fueling credit into certain asset classes more than it would happen otherwise. And that leads to prices to be higher than they would be otherwise. And this is it's one way of looking at what happened in 2008 with mortgage-backed securities. They were essentially overpriced, and they were an asset class that was so large that was used in many transactions even as a collateral. So at that point, you have interconnectedness and a large asset class that is used to back up obligations, but is mispriced. And then at that point, if suddenly people realize that this is mispriced, then you have a cascade, and it gets amplified by the interconnectedness. So, so this, of course, is a big challenge because we don't even have at the moment, a complete mathematical framework to deal with this. But the reason I want to say this in the background is that when we go, we look at the mandate of institutions that are in charge of securing the financial stability, it is a very difficult task because you have to deal with all of this. There is many temporal dimensions. There is a strategic behavior of the actors that you're supposed to regulate, so it's very complex. And what is a very remarkable development of the last, I would say, 5 years is that network models have started to be used widely within central banks, in particular within the European Central Bank. And in fact, the idea of looking at the system as a whole and the interconnectedness was at the base of the philosophy also of the European Systemic Risk Board when it was created back in 2009, right? It was as a result of the famous report of Larosière. So this is essentially a little bit of the background in which you should cast now the two presentations. So I'd like to turn now to Christopher, who will talk about network tools to analyze interconnectedness in the euro area.
Okay, it works. Thanks very much, Stefano. And first of all, I would also like to thank Stefano and all the organizers for inviting me here today to give this presentation. So I'm from the so-called Directorate General Macroprudential Policy and Financial Stability in the ECB, and this is the business area which is in charge of macroprudential policy assessments and financial stability surveillance. And we're also very much involved in stress testing of, in particular, euro area banks, and that's my particular division working on those kind of things. But for these purposes, also network tools and to analyze interconnectedness and contagion risk has become very important over the last few years, and this is basically what I'm going to talk about now. Of course, the usual disclaimer applies, so these are my own views and do not necessarily reflect those of the ECB or the US system. They might, but no, I said it. Okay, but motivation, why are network tools useful for central banks? So, of course, before the global financial crisis, there was relatively limited attention was paid by central banks and supervisors in general to financial stability risks that related to interfinancial linkages. But of course, the crisis changed all that. in the sense that it revealed the intertwined nature of modern financial systems. Shocks hitting one part of the system can easily propagate to the broader system. And we realized that risks stemming from interconnectedness can, of course, be systemic, and also that it's very hard to predict how such interconnected and complex systems can, say, devolve if there's a shock hitting them. So this, of course, highlighted the need to develop analytical tools and indicators, network models that could support our assessments in identifying and monitoring what we at the ECB call cross-sectional systemic risks, so basically another word for risks related to interconnectedness. And a lot of, say, work was initiated also to highlight the motivation for going in this direction, and I list a number of special features that we published in our financial stability reviews over the last few years. Against that background, a number of analytical efforts were put into creating network-based models, indicators, which then has become part of our toolkit, not only at the ECB, but also at other advanced central banks around the world. Also, against this background, a number of, say, macroprudential policy tools were set up to address interconnectedness. I will say a few more words about that later, and I think also Thomas will touch upon that in his presentation. And also, in terms of, say, stress testing, more specifically, what we call macroprudential stress tests, which are stress tests that cover the whole system and not focusing only on individual institutions. There we have also tried at the ECB, but I think also elsewhere, to increase the scope of these stress tests to also account for what we call second-round contagion effects that could arise due to interconnectedness. We have published a number of publications that kind of document how we have done this and how we link that to the broader stress testing work that we're doing. In terms of, say, the scope and purpose of our interconnectedness analysis, also against the background of what I just said, I would highlight 5 things that we are mindful of and are trying to capture. First one is about model complexity. I mean, it's clear to us that, say, the financial system is very complex, and financial institutions, banks, and also non-bank financial institutions are interrelated in a number of different ways, and you need to look at this from a more holistic perspective, looking across the various layers of interconnections among the institutions. Second, say, purpose of the work we've been doing in terms of trying to capture or using networks tools is to assess contagion risk, of course, trying to quantify the scope and magnitude of propagation once a shock hits the system. And as mentioned, we have also done a lot in order to incorporate this type of effects into our stress testing work in general. The third point is, of course, from a central bank, lender of last resort, a type of function, and also as a supervisor now in the ECB, one important aspect of or purpose of using network models is also to identify systemic institutions, meaning those that may be transmitting or amplifying shocks more than others. So these should be the ones which we monitor particularly closely and potentially also applies more stringent, say, capital and liquidity requirements on. So I think network models is a key instrument to help identify these things. Another important point in the work we're doing is that, of course, most of the work we have been doing focuses on banks, but there's also a realization that you need to go beyond bank, looking also at non-bank financial institutions and also beyond to the real economy. And of course, also what many of the activities that banks are doing are, of course, also closely related to other financial institutions. So you also need to build contagion analysis that captures these interrelations. And the last thing is related to our, say, macroprudential policy work. So we are also endeavoring to use contagion models to inform macroprudential policy decisions. For example, what happens to contagion risk in a given network if we, say, increase large exposure limits or impose certain types of capital requirements. Does it reduce contagion risk, and what happens? So we're also trying to develop models that can cater for these kind of questions. Now, another important point, which I think Thomas will also touch upon, is of course that when you want to do this analysis properly, data availability, and we also discussed that in the morning, is granular data is key to really be able to assess interconnectedness and the implied contagion risk in a precise way. And I would say over the last few years, central banks, both at the ECB and also the ESRB, have done a lot of work to start collecting more information that can be used for these purposes. But there's still much scope for further improvements on this side. And often, at the moment, we have to rely on simulations, which to some extent limits the practical use of these type of tools and models. But I'll also say a few things about that later on. In terms of methodologies, I think, at least on our side, we use a kind of suite of model approach where we develop various types of models. I'll list some of the main, say, categories here that we are working on. On the one side, you have, say, balance sheet or exposure-based models. Most of the ones we saw this morning, I think, was in this direction, but you could, of course, also have purely price-based models of statistical interdependence between institutions. Then you can look at, say, direct interconnectedness, say, bilateral interlinkages, but what we also know is that, say, the more indirect contagion links, like through overlapping portfolios or news-based contagion, is also really key and often what is really triggering large contagion effects, if you like. So if you just look at bilateral interlinkages, often you don't find much contagion. So it's important to have these other elements as well. Then in the standard literature, of course, there was more static type of contagion models with simple cascading mechanisms, but what we have tried to, in the direction we are trying to go, is also to have more dynamic models of complex interactions between agents, say, a bit like what we saw this morning, say, having the more endogeneity and endogenous network formation. And there's also a big push to work more on agent-based models, at least at the ECB. So there's a number of projects going on using this type of approaches. Then I was planning to say a few words about the recent model application we have been working on with Stefano's team, but of course Alan presented most of it this morning. So, but this is one of, say, the approaches we are having, where we try to model overlaps, say exposure overlaps, and try to incorporate both direct and indirect contagion effects. And study the implications of, say, diversification and asset allocation. So for the benefit of time, I think I will skip the next couple of slides, so because Alan already presented this morning, but we are using the NIVA approach by Ruka et al, and that takes into account of a number of things that you don't have in some of the standard models that we have at the moment. And another important point is that in this case, we are able to exploit some proprietary ECB data which allow us to very precisely identify the portfolios of different banks and precisely quantify the degree of exposure overlaps. But maybe just two comments on the results, which Alan already presented. I think on the first point I would say is that one of the important implications of this work is that we find that, say, and the second point here on the slide, that exposure classes may be systemically important, not only due to their size, but also due to their position in the network. And that relates a bit to the point I made this morning that, say, currently when we try to identify systemic banks in particular, we typically only use, say, very simple indicators of size of exposures, of leverage, but do not take into account, as supervisors say, the interconnectedness and the network effects, which we document here, but it's of course also documented elsewhere. This is an important element, and if you don't take that into account, you may underestimate the systemicness of the specific institutions and the contagion risk in the system as a whole. Second important point is, of course, what was also discussed this morning about, say, the benefits of diversification and the trade-off between interconnectedness and the cost of contagion. And what we find in this paper is that say, for large shock, a more diversified asset allocation tend to result in a less robust network. And of course, finding this trade-off and where to, say, really quantifying this is a big challenge, but I think it's a very important point for policymakers to know how much, say, additional capital do we need to impose on the banks, or how much large exposure limits should we have? So I think this question is really key to understand as well from a policy making point of view. Second to last slide. Of course, as I also mentioned in the beginning, following the financial crisis, a lot of macroprudential policy tools were put in place, and a number of them includes measures that could help contain contagion risk. What I would also say is that most of them focus on the banking sector, whereas there are much fewer instruments targeting non-bank financial sector and contagion risk that could arise in that part of the financial system. This is something that say, I think the ECB, but also the ESRB is pushing a lot to say, expand the macroprudential toolkit to also be able to target more than the non-bank financial sector. I list some of the main instruments here, but I'm not going to go through them. Maybe one comment on the last one, I think, which links back to what Marco Derico was mentioning this morning, the importance of transparency and disclosure requirements could be one way of say, alleviating and preempting contagion risk. I think that's an important point that I would very much concur with. So final slide to conclude. So central banks, the ECB and others are indeed devoting considerable analytical resources to improve our measurement of cross-sectional systemic risks. But at the same time, it's still very much work in progress, in particular in terms of feeding all that work into the policy process and using it as a regular tool in the policy discussion. I think it's still a bit in its infancy. And I think there are 3 points that I think going forward that we need to work further on. Of course, one thing is regarding again the data needs. So I think in order to convince policymakers that contagion is important and that we can quantify any policymakers that may try to contain it, to confidently use network models in this kind of discussions, we need real-time granular data that would allow us to precisely monitor these things. And I think we also still have some work to convince policymakers that we really can measure these things. And final point, related again to this trade-off between diversification, interconnectedness, and the costs of contagion. I think there we also need to develop further in order to really more precisely quantify and identify where exactly the trade-off lies. And what we often, actually last point, what we often experience when we present things to policymakers that, okay, we have some network models that show that there's a contagion risk in those banks, then they always say, and that we could maybe, if we impose some capital requirements, we may contain that risk. Then they always say, but what is then the impact on the market? Do we kill the market if we do this? And there we still, I think, are struggling a bit with finding the right balance and the answer. But I will stop here.
Thank you very much. Okay, I'll just simply give the floor to Thomas.
Okay. Also on my behalf, great thanks to Stefano and all the conference organizers. It's really, I think, your privilege in the University of Zurich of having this this type of wonderful location and also facilities and also the know-how that you have here. So we have really seen a lot of very useful presentations this morning, and I'm very honored to be here with Professor Stiglitz today. I will also, what is surprising is that actually Christopher and I, we didn't at all coordinate our presentations, despite we sit next to each other. And so we will have some similarities, but we will have a lot of complementarities as well. Christopher is one of, I would say, really leading experts on the stress testing and stress testing methodologies, the banking sector, but going beyond. So please, ask all these type of questions to him, while as all the, let's say, easy questions I can take next going forward. Now, what I want to talk about here is more on our work regarding the derivatives market, so also complementing the previous panel. Here we, I mean, I know that this is Professor Stiglitz laughing, but we are basically coming from policy institutions where only the board can speak on behalf of the institution, so we need to mention this disclaimer that these are our own views. Much of the motivation has been said already in the previous presentation, so I will not make more points than to say that basically we had not only really a lot of interconnectedness that we were potentially not aware of. The markets, particularly in the derivatives markets, were very complex and opaque, as also Marco was highlighting in his presentation, that basically supervisors were presuming that there is big exposures by one of the SIFI banks. So clearly the knowledge and the data was not there at the time. So the big data that we're talking about now, we could talk about big data gaps that time. So that was the reality. Lots of lessons have been learned. Data is becoming available. I would still say that it's not perfect, the situation, at least in Europe, but lots of positive elements is happening. Just to give you an overview of the, let's say, the complexity of the exposures, just and here highlighting a little bit something that is less known, is basically this chart that we call the cauliflower chart. Basically highlights the bank's connections to the shadow banking sector. And what is very interesting here is that we see lots of orange links in this chart, which are those which basically are from the EU banks going beyond EU shadow banking sector. And this work that we have published at the ESRB working paper shows that actually there is lots of connections to the US shadow banking entities. So the global cooperation in supervision and also understanding the global dimension of market is crucial. So Europe is a big entity, but it's still, the markets are truly global. So one has to bear in mind that unless there is a good sharing of information and cooperation, there are limits to understanding the transfer of risk. So I was actually trying to reflect also a little bit the situation 10 years ago. So that time systemic risk models were really at the infancy. So now we are at the teenage. We have gone further, but I mean, I'm still looking forward that the systemic risk models become adults and even when they retire. So we really have done a lot of progress, but clearly there are still limits to the models. Another fact, I recall being in 10 years ago in a network conference. I think Stefano was there as well. We were in Germany. Deutsche Bundesbank organized an event where all the network modelers were actually discussing, so how could we actually become more mainstream? How could we get a little bit more visibility? What should we do so that people wouldn't laugh to us when we present our work? Now the situation is exactly the opposite. So the network guys are the coolest guys in the industry. And when they talk about their programs in Python and R, people are looking at what are they talking about. They are using big data every day. And so, I mean, I'm really glad that the colleagues that are here in the room have continued to push, despite of the initial resistance of really bringing network models to the mainstream analysis, that they sort of did that. Also, actually, if we look back, there were not many macroprudential authorities, so that the term was not something very much used. And clearly, at least in Europe, we didn't have a legislation in a European-wide sense to have instruments to address financial stability issues. We have to keep in mind that this is a little bit, fake type of argument, because I was reading the history of Finland, and I know that in the 70s, the loan-to-value ratio was 70%, for instance. So now we are debating whether 100% or 90% is good, but actually earlier on there were much tighter rules for lending, for instance. Then there is the cycle of regulation and deregulation, so then issues got a bit more relaxed, and then they were tightened again. So clearly, one cannot completely blame that we didn't have instruments or we didn't have the authorities. Clearly, the books this time is different, are good examples of things that, history is repeating itself. So currently, actually, at least in Europe, almost all countries have systemic risk authorities and systemic risk councils and macroprudential instruments. And this is actually, I have to thank my organization, because we set up a recommendation for all countries to set up this type of authorities, and most of the countries have done so. So there is clearly financial stability issues are discussed regularly in Europe. So in Europe, just to say that following the global financial crisis, the European system of financial supervision was created, and here the key element was the sectoral microprudential authorities, so the so-called ESAs, European Supervisory Authorities, as well as the ESRB, which is the macroprudential oversight function for the whole financial system. And our key factor is that we basically bring together all micro and macro supervisors, as well as the sectoral supervisors, around one table, and the table is very big. So if you go to our website, there is a picture of our general board meeting, and you hardly see anybody because the table is so big that it's hard to catch. But we are like 80 members and so on. So that was the idea of the European legislators, that we bring together all the authorities, and that there are issues will be discussed among the authorities, so that at least the information sharing among regulators and supervisors is flowing, so that was one of these issues that was identified in the crisis. Later on, the ECB has become a macroprudential authority for the euro area, but as Christopher mentioned, currently let's say the instruments are limited to the banking sector. Now I turn a little bit more to the financial derivatives markets, and already here Marco was mentioning the importance of the G20 financial reforms, and actually due to this fact, we are now able to do more analysis on the derivatives markets. And the fourth point, which is the reporting of the OTC derivatives, is exactly the fact that we can show you some interesting work. Why we are in a situation that, despite we are able to plot important charts, they are at the time relevant, but they can change and they are state dependent. We saw some presentations today there can be indirect links that are being created when the situation changes. So therefore, it's very difficult to really understand where the systemic risk lies. Clearly the work is going forward, but one has to be really understanding the potential limitations. Like even with the perfect data, one might still not be able to prevent systemic risk materializing. So this is something that we have to understand. Actually, and Marco has highlighted that many times, the standardization of data and really being able to identify the entities now using the legal entity identifier and soon using the unique trade identifier will be factors that will help to really understand the interconnectedness much better. The EMIR regulation, which is the European Market Infrastructure Regulation, it's something similar to the parts of the Dodd-Frank, will grant the ESRB, together with the European Securities Markets Authority, the full access to the EU-wide derivatives markets. And as mentioned, this is following up the G20 reform agenda. And here, the difference to the US is that we not only have let's say the exchange traded, but we have everything. So there is exchange traded and the OTC derivatives in Europe, and the data is complete in that sense. The data is big to our knowledge. This is actually the biggest data set that is being collected at the ECB at the moment. So every day there will be 500 gigabytes of new observations, 100 million observations. Of course, if you show this data to Google, they say, "Oh, this is not big data at all. So what are you talking about?" You know, but at least for us, this is big data. We used to work with, you know, quarterly GDP series, and for 10 years, and then now we have this type of data set. But what makes it even more bigger is that one need to link this data, of course, with the balance sheets and with also with the identifiers, so that you can really work on the data. There will be something similar coming up. The securities financing transactions will be also collected soon in a very detailed way for Europe, and we will be hopefully together with the ECB also analyze much more granularly the flow of repos, and also the collateral reuse, for instance. That was a topic that was mentioned today. So what we have tried to do is, so if we have data, we will work on it. So that has been the attitude of the ESRB. If 500 gigabytes of information flows in every day, it would be a bit strange to store it somewhere and never open it. So we have really tried to do all our efforts that we have with our resources to look this data, and also together working with academics like Stefano and Marco, for instance, or Iñaki, the colleagues that have been today talking. This has been fundamental because, of course, the knowledge that central bankers alone have is not enough. One has to really go to the cutting edge researchers and who bring their know-how and work together with the central bankers and authorities. So this is fundamental, and for this reason, for instance, we are launching this year a cooperation project to work on this data with academics. So our chair, who is Mario Draghi, has in November in the European Parliament just made this comment that you see here, which basically says that large-scale transaction-level data is a milestone and has been fundamental to enhance our understanding of these markets from systemic perspective. This is an illustration of just a snapshot of one instrument in the interest rate swap market and also in the CDS market structure. Just shows you that there are some big nodes which are key to understand, but there is lots of interconnectedness there. And this, as I mentioned, are just one instrument and one point of time. This is an evolving network. multi-layer network. So we have done a lot of research in the last 2 years, trying to really map the interconnectedness, looking at how interest rate risk is being transferred, how actually the work that Iñaki showed, for instance, how banks who are involved in the syndicated loans use CDS, what happens with regard to price formation, how is credit risk flowing in the CDS market, and the macroprudential aspect of portfolio compression, as well as incentives for central clearing. These are topics which have been also published in the ESRB working papers. Here I just show you one work that was in December published, shows basically the interconnectedness of the EU counterparties who are using the CCPs. So there is the green one are those CCP relations with the clearing members, but it's very important to understand also how these clearing members and their clients are linked. So this maps basically the interest rate swap derivatives markets and the counterparties for CCPs and their clients. So what we are currently working on, we are trying to develop a real-time information system that would provide us key characteristics on a daily basis of the financial market structure, but also other types of information about the derivatives markets, and exactly create maps for where there could be risk lying. One important work that we have been doing already is to enhance the data quality so that it's usable. But of course, everything is underlying that you have a strong IT infrastructure that can handle this. So where do we stand? I think we need to acknowledge the complexity of the financial system with the direct and indirect connections and interactions. And basically, even single types of vulnerabilities can, due to these interconnections, become systemic risks due to or depending on the situation. So it's sometimes hard to, see this where the systemic risk really lies, but lots of work has been done. Christopher showed a lot of work, and we have hopefully also understood more this situation. So last slide is where do we want to go? So clearly lots of progress has been made for availability of granular and precise data and the ability to analyze it. So lots of progress has been made in scientific literature, and also how the authorities have been applying that scientific research. And so the know-how has improved both in academics and the central banks. And clearly there is a very long way to still put everything together and to see all these interactions to create proper systemic risk maps. One important avenue which Christopher highlighted as well, and there was also agent-based model in the earlier session, is really to understand really the whole financial system, how that is interconnected and how that will interact. So all this work on doing system-wide stress testing using agent-based model is to me a way to go. Thank you very much.
Thank you, Thomas. So I'd like now to turn to Joe and ask maybe two simple questions. One is, in your view, what is the added value of this network data network models for financial stability and macroprudential regulation? And if there is an added value, why is it that this is has not made it to the more widely into the decision making?
Well, thank you for having me here again. And let me begin by saying that I think the presentations that we've had demonstrate that it is beginning to make its way into the decision making. And I think this is real progress. I think there's probably more progress here in Europe and in the Bank of England than there is in the United States. Even though some of the motivation from this came from the United States. You know, when the Lehman Brothers went down, Everybody knew that Lehman Brothers was going down, at least in New York. Everybody knew. It was just a question of when. And it was remarkable that the New York Fed and the Federal Reserve did not know the links between Lehman Brothers and the rest of the financial system. They literally didn't have this mapped out. They didn't know what was going to happen. And so they were almost taken by surprise at the magnitude of the consequences. And I think that has been one of the reasons why policymakers, except in the United States, have really taken on the lesson. Why the policymakers in the United States have not taken on his board as strongly, I think, has to do more with ideology and the role of DSG models being so entrenched. And I'll come back to that in just a minute. First, let me say that this notion of the importance of interlinkages is something that we get reminded of over and over again, and it has been a surprise it's taking so long. So when I was in the White House back in 1994, there was the Japanese crisis, and we were panicked knowing that there were all these linkages between Japan and the United States that we didn't know precisely, but we knew that there were enough to put American banks at risk, but we didn't have the models. So we sat there and fretted and got anxious and had meeting after meeting, but we didn't have any of the data. And then my second big lesson in this was the East Asia crisis of 97, 98, where you wound up with not only systemic bank crises, but systemic economic crises, where you wound up with 70% of all the firms in Indonesia in bankruptcy. And that's actually what motivated me to begin the kind of work that we began to work on with Stefano before the 2008 crisis. In my book with Bruce Greenwald, we laid out models of systemic risk and how a bankruptcy cascade could build on. It was really motivated by that. We were always disappointed that people in the central bank didn't pick this up, but I think now this lesson, as you've demonstrated, has really been taken on board. Let me try to say why I think this is so important. If underlying all these problems are, from an economic point of view, are the presence of externalities. If there were no externalities, we could have aggregated what was going on into a representative bank and a representative agent model. But there are externalities, and when there are externalities, you cannot describe the financial sector as acting as if there were a single individual. And each of the agents in undertaking individually rational contracts with each other are not acting in the interest are not necessarily acting in the interest of the financial sector, let alone because there are externalities between the financial sector and the real economy. What they're doing is not necessarily in the interest of the economy as a whole. This means that there is an important role, because there's this massive market failure at the macroeconomic level, that there's a role for regulators, and the central bank is the important regulator here. And so what I want to do in my few minutes here is talk about the role of the central bank in three ways. One, in terms of information, secondly, in terms of a regulator, thirdly, in terms of a lender of last resort. And the point here is that in all these areas, there are important market failures. Information is a public good, and so there's no reason to believe that the market itself is going to make available transparent information in an efficient way. So just to go through these things just fairly quickly, and some of these points I'm going to make are going to echo what was said this morning. First, on interbank, is the issue of interbank lending. One way of seeing the central bank is as a clearinghouse. We have this very peculiar system that Bank A lends to Bank B and Bank B to C, and meanwhile, they're also borrowing and lending from the central bank. A natural question is, why is there this interbank lending at all? Why doesn't everything go through the central bank? And then the central bank, in terms of lending, would have all the relevant information. And it would, like a clearinghouse, would be more robust. And this is especially true because in the end, the central bank is the lender of last resort, so it's going to be absorbing the risk in the end. So why not make it the focal point of all the lending? Well, I don't know the answer to that. And so what I'm asking is some questioning. I think that one of the reasons is that they don't want the central bank to know everything that is going on. And therefore, this is an argument that we should not allow interbank lending, or we should discourage interbank lending and try to have everything go through the central bank, which will create a more stable financial system and one in which there is more information. The second question is, given all that information, should the central bank, how much of that information should it reveal? And now it has all these gigabytes. And should it help Google by giving all those gigabytes to Google? Well, it's a very big issue. If the U.S. Fed had disclosed the information that it had about the lending that it was engaged in, the number of the banks were in dire straits, it knew it, but it didn't tell anybody. So the question was, it was acting in a massively dishonest way. Bernanke was saying things like, don't worry, there's nothing going on here, the risks are contained, and he knew that was not true. So the question is, if he had disclosed it, would the crisis have occurred earlier? But having occurred earlier, it might not have been as severe. And therefore, do we really believe in transparency? He wrote a lot of papers about the benefits of transparency until he became the head of the central bank. And then he took a different view. We actually had to we had to have Congress demand information from him. He would refuse to get it, and I had to write some letters through the congressman to get the information that we wanted. So he would say that information was dangerous to the financial market. I tend to think that a bit more transparent financial market is better, and that what happens when you have less information, it is more likely that you have the kind of freezing that happened in September and October of 2008. So I think these are just very big questions that central banks have not opened up to, and I think it would be interesting to have a more open discussion of this. The third issue is, and the most important is, the central bank as a regulator. And there are two big issues here I want to talk about very briefly. One of them is, echoes what was said this morning and a little bit this afternoon. We know the problems posed by too big to fail banks. We haven't fully addressed it, but we know about those problems, and we know that the too big to fail banks need to be more scrutinized because they have incentives to engage in excessive risk-taking. But at an abstract level, we now know with network analysis that we can also have two interconnected to fail. And that greater interconnectedness, work that Stefano and I have done and other people have done, creates more uncertainty. There are a whole set of complexity leading to more difficulties in regulating the financial system. So we can't stop all of it, but the CDSs may not be performing any useful function. So the good news is the chart that we saw this morning is they're declining markedly. But and one of the reasons they're declining is they're subject to strategic manipulation. There was just another case of that kind of strategic manipulation of a default that was staged in order to have a payoff of CDSs just the last couple of weeks. So we know that these markets can be manipulated strategically, but we also know that they create more interconnections that can lead to more systemic risk. So the question is, what is the benefit and what is the cost? And I haven't seen a compelling case for the benefits, and if in the absence of that kind of compelling case, they should be banned, especially the naked ones that were talked about this morning. The second one is a broader issue of network structure. One of the things that we've learned in discussions of networks over the last 15 years is that the structure of networks matter. But we're actually not sure what are good structures and what are bad structures. We know they matter, but, and this is one of the important areas of research, but let me put forward a couple of ideas here. One of them is that we know, for instance, that the idea that people like Bernanke and Greenspan promoted, that the more diversified risk is, the lower the risk is, that idea is wrong. And the question is, we haven't fully taken on board the reasons for this. That is to say, what are the mathematical structures that lead risk diversification to be bad rather than good? Why is there amplification rather than risk reduction? But the second point is that there's a lot of discussion recently about bail-ins rather than bailouts. But most of the attempts at bail-ins have not worked. And the reason they have not worked is that the government's statement that it will not bail out is not credible. So to have a credible bail-in policy, it has to be believed that if the private parties don't go along with the proposed bail-in strategy, the government won't bail out. And so you have to ask, what kinds of financial structures are most amenable to bail-ins being credible, or a bailout not occurring being credible? And that reverses some of the long-standing presumptions. It turns out that if you're trying to get a bail-in, then sparse networks are better than dense networks. And that you can, so looking at the benefits and costs, so now we're looking at the full benefits and costs, it turns out, therefore, in that kind of a world, where you have an option of bail-in and bail-out, sparse networks are the optimal network design. And that raises a broader issue. Trying to regulate the behavior of banks has proven extremely difficult. As one of the regulators that I know said, you know, if there's any space between the wall and the wallpaper, the banks will find it and exploit it. So this leads to the view, if behavior is hard to regulate, it's not impossible, and some of the regulations about buffers are, capital requirements are actually implementable, but broader behavioral regulation is difficult. We ought to be thinking about structural regulation. You know, banks that cannot engage in certain kinds of activities. Universal banks are not good. Universal banks lead to too correlated to fail, another set of problems that I haven't had the time to talk about. So if you want an ecology of a banking system that is robust and doesn't have systemic risk, we have to begin to think more of what kinds of structural regulation will enable us to achieve that.
Thank you, John. Well, I think you have been probably anticipated much of the some of the questions that would have been in the QA. I remind you that you actually need to leave the room at 15 because you have a call with Davos. So I'd like to open the floor quickly for questions. Yes, please, over there.
Thank you. So the question is about reporting.
It has to be
Brief.
short and concise, because I'd like to give a chance to Thomas and Christopher to react a little bit to Joe and then have a wrap up.
Okay, my question is about, what I want to say is that data transparency is important, and I'm sure this is useful. It's much more useful than a quarterly GDP data. But what about transparency on reporting in terms of the business models of the banks and the financial institutions? What are they doing exactly? Reporting actually what is their business model in an easy to understand, simplified way that then consumers, public, even corporate clients can understand, and allowing that to have an effect on transparency, because I think there's a lot of intransparency in how things work in the financial sector. And of course, data allows you to understand who's connected to who, and on some sort of macro level, you get an understanding of the system and the interdependencies. But you need to also understand what is happening, in terms of the business models. Is there reporting, and who is the entity who can require that kind of reporting?
Thank you. Yeah.
Thank you for all the panelists and the moderator for the interesting talk. One question I have is, as Mr. Christopher Koch had mentioned, the linkage between stress test and real economy. I think especially under the systemic risk context, the real economy's fragility is very important, while it's not really often talked about together in the same picture. So would all the panelists please shed a little bit light on it and also enlighten our young researchers on this topic? Thank you.
Why don't we stop here and react to these, and in the meantime, so if you can also react on Joe's observation. Stop.
Where to start? Also. Okay. No, I mean, thanks a lot for all your comments and suggestions. I think it's actually concur with more or less all of them. I think you mentioned DSG models and their inability to account for heterogeneity and externalities and so on. And I think this is really a challenge we face, because although at ECB and also Bank of England, we are trying to use this kind of more heterogeneous agent type of models more often in the policy process. DSG models and other macro models are still, say, the main policy tools that is informing the policy discussion. So some things that we are trying to work towards is to try to marry the two in a way so that we have this kind of individual agent type of models and try to inform the DSG models in various ways. It's not a trivial thing to do, but this is at least the ambition we have. Yes, in terms of the information issues and how much we should reveal, I also, as I also mentioned in my talk, that find the disclosure a very important element in trying to reduce systemic risk. And I think it's true that in some cases, in the middle of the crisis, the central banks definitely have an incentive not to reveal too much about which banks are in trouble, and especially now we also have supervisory authorities, and we know when we speak to our supervisors, they don't want to reveal anything. But I think having disclosure requirements, say, on a more structural basis, could actually preempt many crisis events. So I think that's an important point, and I think also in Europe, in the stress testing exercises that we had, for example, in the EBA in the past during the crisis, they were very much criticized for not being stringent enough, but at least one thing they did, which was right, I think, was to put a lot of data about the bank's exposure out there for everyone to see. And I think that at least was helped resolve some of the issues that we had with the banking system and help unfreeze the markets. I also agree on the bail-in, bail-out thing about the credibility, and we also have some recent studies that looked at say, the implications of bailing in from a network perspective, and indeed the networks which were more sparse and where banks were not so interconnected in terms of cross-holdings were also the more robust. I fully concur with that finding, or with that observation. Yeah, I don't, maybe.
Thank you very much. Yeah, not much time to answer all the very good questions, and many thanks for your very good points. Just to highlight on the transparency, we were at the ESRB, we published an occasional paper a couple of years ago called Indirect Contagion, and there one of the, let's say, new elements was indeed like when the Systemic Risk Authority should reveal information about exactly of the potential interconnectedness of certain institutions or so on, to really alleviate the potential of freezing of the markets and panics and so on. Of course, clearly, if the situation is bad, then it can really lead to further amplification of problems. But the idea is highlighted also in this occasional paper. On the transparency regarding the, let's say, green finance, Europe is a lot working on this topic at the moment. Also, the ESRB is starting again new projects on really looking at the stress testing and green finance. One issue that I want to highlight, there was a report from the scientific committee called Too Late, Too Sudden, the transition to low carbon economy, which is quite a good reference to start let's say, understanding the situation, what are the challenges and so forth. On the portfolio compression and the CDS market size, one thing I think is very useful in this exercise is that at least some excess of the exposed is been removed and the opacity has been reduced, so at least some useless connections exposed are being removed. They might have been useful of finding the relevant risk sharing at the time or the pricing, but exposed they are not relevant. So there can be, of course, other issues that can emerge for potential new linkages, for instance, that the entities were not aware of can be created and so on. But clearly there are also positive issues. To my understanding, the naked CDS is banned from Europe. So this is at least something that I think is also useful. Looking at still the questions that we see here, I'm actually not in a position to answer them, but just to tell you that the ESRB has worked on the macroprudential issues regarding low interest rate environment and has in 2016 published a long report on all potential dimensions that the low interest rate environment can generate for financial stability. Thanks.
Maybe there's. We have to finalize now.
Let's say 2 more minutes in total. Maybe if there is a question that you feel really that you want to answer, otherwise final statement. But you
okay.
feel really...
No, I mean, there was a few questions on QE and what it means for systemic risks, and I think, of course, that's a bit of a tricky question, but I think they probably need to stick with the policy line that say, of course, QE in the first place is about increasing risk-taking because we think it's too low, in at least in the euro area at the moment. And then what we are also saying typically is that indeed it may create some vulnerabilities and systemic risks somewhere in the financial system. This is something we are monitoring, of course, but that this is actually then, in turn, that were to materialize, that would be the role of macroprudential policies to address, not really of monetary policy. So I think that would be my main point on that question.
So there are really many questions, but there's no time anymore, otherwise we don't have a break. So feel free to approach Thomas and Christopher to discuss some of those. They're actually very interesting ones. I'd like to, we really have to wrap up, so unless you have would you like to say a final 10 seconds, getting tired, 10 seconds final statement to take-home message from these network models for central banking?
Okay, 10 seconds. Yeah, I think there's still a bit of work to make it, say, mainstream models in the policy work, and especially, I think, on this trade-off thing with cost and benefits of interconnectedness. I think that's where we still need to work on trying to quantify that better and more precisely be able to inform the policymakers.
Exactly, and we need more granular and precise data in order to do the analysis, but we also need to have the ability to draw conclusions, so the cooperation between the scientific work and the policy work is essential that it continues, and I encourage again all the researchers here to continue the good work.
And this is an encouragement for all the young and brilliant researchers in interdisciplinary science to approach this fascinating field of applied science. So with that, we have to close the session. Join me in thanking the speakers again, and Joe, who, as I anticipated, had to leave at 3:15. Let's thank the speakers.